Hello again, and welcome back to the set of Building Blocks. Today we're filming at 33 Yonge here in Toronto in a model suite that we actually took a walkthrough of the last time around. Pleased to say today that the suite that we're sitting in is now fully leased. I'm once again joined by Steven Marino, who took last episode off while we batted around sort of bigger picture economic and political issues with Wendy Waters. It's good to have you back, Steve.
Pleasure to be back. Looking forward to today's conversation, and always great to celebrate leasing some office space.
For sure. Testament to our great leasing team, office leasing team, who I'm sure we're going to get into a little bit more with as we move forward today. A few episodes ago, or maybe it was 2 episodes ago, we spent some time thinking about which asset classes were best positioned to potentially be the best performers of our 4 main asset classes. At the time, I think we both landed on the fact that retail was likely to be, in the near term anyway, the best performing asset class, but left the door open for office to be the surprise to the upside. How do you feel about that today?
I probably feel even more strongly today than I did then, and I was pretty bullish back then. I think the question of time and horizon is always an interesting element of that forward-looking element of how you think about your portfolio and where it's going. I start with the fact that we have a really robust valuation process, and that robustness is based on the frequency of our valuations. We value all of our assets on a monthly basis, and the fact that we also weave in external valuations on a quarterly basis to enhance the independence and transparency of our valuation process. So we always have a mark to market, if you will, on our assets that is current. And that's important so investors can take comfort that as they trade in or trade out of our fund, they're getting a fair real-time reflection of market value. As I think about the journey of office valuations over the last 5+ years, I think about 3 factors that have really influenced values. I think about market rent. It's certainly come down as market conditions have softened. The cost of doing a lease has certainly increased. And so whether that's the investment that goes into the space or the investment into the lobbies or into the amenitization of a building, that has certainly increased. And then lastly, the cost of capital or the discount rate that gets applied has certainly changed over the course of that time. And over the course of that, let's call it 5 years, those 3 factors have generated something like a 50% plus change in value to the negative. And so when I think about that valuation process,
much different basis today than we had, obviously, just a few years back.
So absolutely. So the crux of that is that today's valuations are effectively 50% less than they would have been 5 years ago. And so an investor in our funds today gets the benefit of that reduced cost basis as they think about the forward performance of the assets. And so we're going to talk about how the conditions are materially improving, but really it's the setup, as I would describe it, for future performance. All of that investment and valuation change is now set up for what I would describe to be probably the most attractive asset class on a go-forward basis.
So you were touching on amenities and building capital in your remarks there. Do you want to maybe expand on that a little bit? Thinking about 33 Yonge here, One Adelaide, other assets across our portfolio that we've put through extensive major capital programs and amenitized in order to be able to compete with the best-in-class assets that are on the market.
So it's a great question specifically. I would say value, as the tenants define it, has always been critical. And so as owners of buildings, we certainly have a view of where we think tenants will want to be and what amenities are important to them. It's important for us to continue to reach out to our tenants. We survey them regularly to understand what they're looking for and what helps them to define value and helps them in their decision-making process. And I would say routinely, amenities like conference facilities, fitness, end-of-trip facilities, they come up as key decision makers for them in terms of how to prioritize assets and how to think about using space.
It's become table stakes now for most tenants, aren't they?
Absolutely. So I would say the proximity to transit alongside with those amenities are really key and critical for us. And so as we think about investing in office buildings and picking new office buildings to invest in, we're looking for those same amenities to really create resilient cash flow growth and the ability to drive performance. Those are really the staples of future cash flow generation.
Okay, let's shift gears a little bit. So we've talked about the journey that office values have been on. I think you did a nice job setting that up. Maybe more in sort of real-time market conditions, both sort of for the sector as a whole and what we're seeing in our portfolio.
Sure. So I'm going to go back, though, just talk about market conditions a little bit, because I think it's important to understand where we are. And so today, nationally, it's an 18% vacancy rate across the country. Wind the clock back 5 years ago to Q4 2019, vacancy rate would have been about 10% nationally. What happened over the course of that 5+ years is we saw the delivery of 26 million square feet of new office buildings. Again, somewhat regrettable in terms of the timing, but office buildings take a long time to build. And so you launch a building in one market condition, it arrives in a different market condition, which may or may not be agreeable. We saw 21 million square feet of contraction or reduction in office demand. So tenants were doing more with less, as I would describe it, at least on an interim basis. And then finally, we saw about 8 million square feet of demolition of office space across the country or conversion. You net all that out, we saw vacancy rates go up from 10% to 18% today. On the surface, that number seems troubling, and I would say that number certainly is elevated. But it's also important to think about this as not being a game of averages. You need to think about where your assets are located across the country and how well positioned are your buildings to compete within the marketplace. And probably the single best example in downtown Toronto is that Trophy Towers in downtown Toronto have a 4.4% vacancy rate, even though the Toronto market as a whole is north of 18%. So tenants are truly valuing quality today more than ever before. And if you can have quality be part of your offering, you're going to be rewarded both in the way of rent and in the downtime that you can mitigate and create cash flow with on the other
Yeah,
side.
so we're sort of circling back a little bit to the valuation conversation, but all of that capital is behind this. Our buildings are amenitized, and the deals that we're doing now with tenants are starting to become more and more creative because of that.
Absolutely. And I think the other important element of the conversation that's real time is the decisions that are going on by a lot of large organizations, including some of the biggest banking organizations in our country, that are mandating return to office a minimum of 4 days a week. And so we saw a couple of those significant announcements in Q2 that are going to be manifesting in the second half of 2025. Those are certainly big drivers of demand in downtown
And
Toronto.
a
And
couple
other
of those
major
big
markets.
names are the culprits for the 21 million square feet that came back in the first place. So
Funny how that happens, right? Tenants contract, tenants realize maybe they've contracted too far, now time to go in the other direction. And I would say that's happening real time. In the same breath, we're seeing a number of other tenants in other sectors who are also making similar decisions in terms of the need for more office space. And so we're seeing requests for proposals for new office demand across the country. And really, those buildings that have those amenitization programs in place have a key competitive advantage when they think about how to position themselves. Do you want to be offering the building that is hoping to deliver those amenities 2 to 3 to 4 years from now, or be actually able to point to the quality list of amenities that are in place and ready to go so that day one you step in and get to enjoy the benefit of the fitness facility and the conference facility without having to wait for those
to live through it. Yeah.
Yeah, absolutely. So it's a great competitive advantage, and I would say certainly happy to have that at our fingertips.
Well, and they're tools that have certainly helped our leasing team. They've been incredibly busy lately. Our office leasing team across the country has locked up around 400 basis points of existing vacancy, which is a great news story. So some of those deals, like the one we're in today, this model suite is quick to cash flow. Others have a little bit more of a lag, but ultimately those are going to drive performance for us.
And Craig, the other thing I guess I was remiss not to point out is on the government side of the equation, we're seeing provincial and federal governments across the country starting to making more regular statements about return to office expectations. So over and above the private sector, certainly the public sector is following suit, and all of that should ultimately lead to more vibrancy within our communities. And that bodes well both for office demand, but it bodes well for retail demand. It bodes well for residential demand. I think it ultimately bodes well for the Canadian economy as a whole. And we know as the Canadian economy goes, so does real estate. So I really like that circuitous nature of the relationship we've talked about here.
What else within our portfolio specifically? We've talked about some sort of broader momentum triggers that are out there. I think generally speaking, we're pleased to see the direction where things are going, but just in terms of our portfolio and where you see the upside.
Yeah, certainly. I think the team's done a great job of mitigating near-term exposure in the portfolio. And so we've locked down a lot of key tenants that have large expiry profiles. That helps to secure, I would say, resilience of cash flow in the immediate term. In the same breath, I think we've now got a lot of this capital work behind us. And so we're really positioned to take advantage of the hard work we've done over the last few years to complete those amenitization programs. And we're seeing the fruit of that labor real time as, we're starting to be at the top of the list for a lot of lease transactions we're looking to effect. And so that in combination with the strong teams we have on the ground locally and in all the cities across the country in which we do business are combining to create some excellent outcomes for us. And, leasing office space is obviously one of those great outcomes. I think it's important to think about that. Maybe going back to one of your opening questions about office valuations, those valuations assume the downtime and the market rent conditions that are going to be used to ultimately lease space eventually. If we can outperform those conditions, we create value, and that goes to the bottom line of the investor's return profile. And so every time we can accelerate our lease up and do it faster than was otherwise forecasted, we create value. And I'd say we're starting to see some really pleasant surprises to the upside, which are highly indicative of the success of our programs and our conviction on these amenitization programs. So nice to see that coming together real time, and our investors will be the benefactors of that.
Yeah, after a number of years of disruption for the sector, it's great to see some recovery happening in real time, and I know we're both certainly obviously very positive on what that looks like moving forward. I think you sort of touched on this, bigger issues than just real estate. We need our downtown cores to be fully activated in order for our local economies to thrive, our national economies to thrive. It's critical ultimately for our cores to be hubs for business and fun. And we need more people back downtown. It's good to see that people are starting to trend back that way. Steve, thanks again for joining me this time around. It was great to have you back.
Thank you.
And that's all for now. We'll see you next time on the next episode of Building Blocks. Cheers.